Hi there, welcome to Funding by Alex. My name is Alex, and today I would like to talk to you about hockey stick growth. Maybe you've heard of it, and today we're going to dig into what is it and why should you chase it. So let's start with the importance of growth for a startup. So you have the idea, you have basically put your team together, and you have funding. Based on that funding, you have a baseline for investment. So it's a starting point, like normally you soft launch, then you actually get some pre-seed funding or seed funding if you already had pre-seed funding. And then you are going to build the idea. So you're going to build whatever you are planning to build. And investments normally are meant to help you scale. So in the end, except for pre-seed and seed investments, so pre-seed investments are actually really to go from ideation to okay, let's make a proof of concept, build the prototype, build the minimum viable product, basically the MVP, and go and build it. So you have this idea on paper. Let's make it real. Seed investment is basically the step further, where you actually build it into something that you start to test the market with it. So not with big scale advertising, big scale user acquisition, but you are basically able to start your idea and prove that traction is there. So pre-seed, I would say, really is okay. Make something that could be put into the market, and then seed is actually like how can we actually make traction happen. So try with a very small investment to get traction. Like prove it that you can do it. Prove also that your team can do it if you have basically no track record. Then after that, of course, you have additional capital you're raising, which is converted into resources. So normally after this seed stage, pre-seed seed stage, you actually get into the scaling stage. So that's where you are looking at maybe a pre-series A, a series A. So all these beautiful terms are actually coming from there. So let's say you do a series A, maybe $5 million series A. That would be an amount you would be able to raise. And that capital, that $5 million, you are actually going to convert into resources. So these resources are actually people, are additional equipment, additional technologies you need. You basically are going to scale up every part of your business in order to make sure you can actually access the market. So this is where you need to put it into motion for growth. So there's a lot of companies that I've been involved in that basically had raising as the primary goal. So like we are raising capital for the sake of raising capital, and yeah, it sounds very ridiculous, but there are actually founders who raise capital and then afterwards, figure out like what to do with it. So in the end, you have to have some rudimentary idea that you say, okay, when I raise $5 million, this is what I'm going to spend it on. Tuck, tuck, tuck. Normally, investors will also not let you get away without specifying that, but once startups are getting into Series A plus, Series B, Series C, you it becomes scarcer basically or sparser, that the fear of missing out, the FOMO, is actually getting into the head of the investors, and there's a bit less due diligence, I would say. It's not no due diligence, but it's a bit less, and sometimes this is an afterthought. So it's not a shame to say, hey, I had this in mind when I raised, but I need to pivot or I need to actually change my plan. That is fine. Yeah, we're human. We actually, if the facts change, your opinion changes. So in the end, you need to adjust and adapt. But these additional resources you need to deploy in order to grow. So in order to grow whatever direction you're looking at growing. Now, this is also the time when a lot of money gets wasted in startups. So in the end, if you look at buying things that they don't need, hiring people for far too much money because they feel they have to have someone with an Ivy League, education on board. Not saying that that is never a good idea, but there are moments when you say, look, there are other priorities where you should maybe put your capital to work rather than hiring someone with beautiful pay package basically, and pay him a lot. So in essence, once you deploy these additional resources, so let's say you are still looking at lean and mean, so always try and do this without say, okay, there's a big amount of money in my bank account now. Let it roll. Try and be frugal all the way through, because don't forget you're spending other people's money. So in the end, they've invested in your company, they got equity, and if it's not debt, at least, then if it's equity, then they become your partners, part owners of the company. So you need to actually treat it also like you have got some people on board who've invested, who put their capital to work, not because they are big companies that you can actually just waste it or squander it. Uh, be very frugal about what you do. That is my advice. Then, of course, what these companies actually do is invest in you in order to see the company grow. So let's say I scale. Having said that, I need to probably explain that there are companies that VCs actually, that investors, angel investors as well, that specialize in certain stages of getting in. So pre-seed, seed, then you have Series A. There are also companies that only come in after Series B and up. There's various VCs that specialize there. For every single thing there is a specialization. Sometimes it has to do with check size. So it's not just that smaller VCs are actually specialized in also smaller startups, or that they are getting in pre-seed or seed stage. Of course, admittedly, the capital layout for those stages is, of course, smaller than when you get in on a Series B. Series B, you need to probably already bring serious checks to the table. The thing is also that, in essence, the earlier an investor invests in a startup, the cheaper the equity is. So, because let's face it, if you invest in someone who is in pre-seed stage, meaning the idea and it needs to actually become real, you are taking a lot of risk. So the risk is high, therefore the reward has to be high, meaning yeah, investors actually get more equity for the dollars that they invest. Once you progress to seed stage, Series A, so let's say someone who gets in at the Series B versus someone who gets in, let's say, at pre-seed stage, the same equity might be 10x 20x already. So in the end you're talking about a huge increase in valuation. So uh, this is also something where people who get in at the growth stage, which is actually the stage that a lot of VCs are specialized in, because that's where the fun happens, I guess. You are looking at something that has already got some traction. It's there, the concept is built, the traction is there. Then the only thing they need is the money to actually scale it. Now, then it comes down to market conditions and, of course, whether the team is capable. So the idea of a company attracting this sort of investment is that the investors' upside is, of course, that in the end they get a higher valuation. So in the end, the company they invested in, so they invested maybe $500,000 for a Series A of 5 million. Then they that's part of their portfolio now, and that $500,000 actually becomes worth $2 million in the next round, because the valuation goes up after the company grows and reaches all these milestones. The roadmap actually that they have put together, the milestones that are coming. So this is actually something that that's the reward. On the other hand, the risk involved, of course, is for a lot of investors that a number of startups actually fail. So if you look at the amount of startups that fail is spectacular. If you look at maybe 95% of the companies that actually receive investment also in the end fail or pivot to something else, basically. It's a huge number. So therefore also, there's a lot of capital layout where the people are actually taking the risk and need the reward. So that means that if you, for example, as a venture capital fund, you are, or an angel investor, you invest in multiple companies, you hope, of course, that one of your horses will actually bring in, enough to pay back for all the losses you are incurring. So it's a numbers game. This is for the high net worth individuals. If you are an angel investor, of course, and for venture capital funds, they have a mandate from, in essence, also high net worth individuals and what they call limited partners to actually deploy the capital on their behalf. So limited partners actually lock up capital for a fixed amount of years. That's what they call a closed-end fund. So let's say we lock up your capital for 10 years. and then basically we are, have a target for a return of this much, basically, and you get so many times your money back. So let's say we 5x or 10x your income for your investment. So this is something that, yeah, I mean, losing sight of this, where you say growth for the sake of growth is actually something that a lot of companies seem to be chasing. Yes, I need to grow, 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 and that is a bit of a model where people are looking at, you know, how big do you need to get in order to become profitable? So this is something I'll go into a moment, but the point was, like after the time Facebook, for example, is a good example where there was no clue on how this company would, reach profitability, if ever, with regards to, they just had a lot of users, a lot of engaged users, and in the end, the model was we earn it back on advertising. So the advertising is actually what the users were looking at, and that is how we make money. That's our income source. And still, Meta is actually very much reliant on income from advertising. Other services are not, contributing that much. But if you look at Meta in the sense of, was it actually a model that a lot of people copied? Yes. So in the end, that seemed to be a bit like the holy grail of let's grow, let's give it away for free, let's not charge anyone until we reach a certain size, and then we can actually start, having advertising income from various users that we have acquired. Now, that model is a bit outdated now. So because there's only one Facebook, so that's the thing. So you have, of course, Instagram and all the other ones that are also acquired by Meta, obviously. But I mean, that's something like a model. Like just because one person did it, doesn't mean that it is easy to copy. Because of course, 16,000 people have the same idea. Yeah, it's going to get crowded on that market, and that's why in the end, other growth strategies need to be considered. So, key considerations for investors are whether future growth actually needs additional resources. So, if you grow more, do you need to add more resources, or can you scale with the current resources? Now, what does that mean? It means that, for example, in a previous startup that I have been involved in, we had a lot of B2B customers, so business to business customers. We actually were acquiring stores, and these stores we could not only onboard with technology, so we were only able to we didn't crack the technology part of it. So there were a lot of people who were very analog analog store owners, very traditional markets basically, and to onboard these people we had to basically physically knock on doors. So for that you need people, and at some point we were actually growing our revenue, but we also growing our people and number of people. So meaning also we're growing our cost. Temporarily, that could be something. If you say, look, there is a point where you're investing in people and you add more people, then temporarily you reach a certain point where the revenue keeps on growing, but you don't add more people. So that is actually the point where you say, does it need additional resources? Now, technology is an enabler. So you look at a lot of different technology solutions that could help, growth, further growth of companies. For example, we had an app to actually support the salespeople that were going to the store. So the people were actually able to, without the guy coming to the store, they could order on the app. It's just that with a shift in habits, like in essence, to change habits of people is always an uphill battle. I would almost very much strongly advise any startup which involves changing habits of people to think twice before you start this. Changing habits is actually something that's very time consuming, very intensive. So it's not impossible, but you're basically looking at probably investing far more than you actually get back in the short run. So we had people physically going to stores, explaining the app, so the platform that we were using to persuade people to order online. And The platform was still not perfect, and the app was still not perfect. So we had a little bit of a challenge to, get user satisfaction. So, provided you get that right, yeah, technology can be an enabler for users. If you have tech-savvy users, in this case, the example I just gave was very traditional stores in Indonesia. Someone in the middle of nowhere, someone with a cell phone, trying to order something on a cell phone. So that required a lot of intensive, yeah, I would say hand holding from our people. So we actually were unable to really scale that beyond, a certain size without adding more people. So, um, but yeah, I'm saying this. Currently, we have another paradigm shift in technology, which is, of course, the advent of AI. AI is, yeah, there's a lot of buzz around it, and of course, a lot of snake oil, so to speak, snake oil sellers, which is about something you slap AI on something, and hey, it suddenly becomes this futuristic sci-fi thing. I did a video on that last week. So basically, if you look at AI, you have three types. So basically, you have generative AI. Now, if you've used ChatGPT or Midjourney or any language model, basically, where you just text prompt something, basically, then that is where it spits out something, or it generates something of an image. It compiles a lot of things from whatever is available in the public domain on the internet, and some things are not in the public domain, obviously. So then you have predictive AI, which is actually something that is used for interpreting data sets that are, yeah, basically historical data, where you say you predict future behavior, future outcomes, basically. It is, very high potential. It is also has some very, yeah, serious limitations, obviously, because if you only go for historical data, it cannot really interpret the context yet of something, or any bias that might be in your data that could actually, was it translate into again, a biased outcome from predictive AI, basically. So that is something that is really, the future. Though, if you look at predictive AI, more data becomes available, more data sets become available. Of course, predictive AI will be, for example, an algorithm, where you say, like, look, we're trying to predict much better what should be available in a retail store, or like to actually fine tune production in a factory. Okay, we actually fine tune production schedules and all those things. Logistic streams can be optimized with that. So there are a lot of things that you can do with predictive AI, which is, I think, a very hot, trend at this moment. It's not new. It's been decades old, of course. AI is decades old in essence, but that's the proto AI we're talking about, basically. That currently AI has been slapped on it as a label. Now, the third one is content moderation. So in essence, that is more where Facebook is actually flagging posts, for example, for racist content or something like that. Again, not perfect. Sometimes they are very strict about something. If someone is actually doing something with, let's say, a post actually, giving examples of racism, and they are actually against racism in that post, then they're still flagged as being a racist post, for example. So that is something that it's not perfect. It cannot find the nuances yet, basically, but of course it gets better every iteration of these AI models, basically. So these technologies are available with regards to AI. Of course, you're looking at other technologies where you say, look, rather than a guy going into a store with a notebook and writing down orders, you also have a POS system, for example, point of sale system, where people can actually just press a button and say, I want to order this, I want to order that. So that's something that would be technology as well. And of course, automating business processes. If you look at the way a lot of startup founders are actually looking at consumer-based solutions, because let's face it, we're all consumers. So what is the most interesting thing that you can think of is actually a consumer product that you can use, or can make my life as a consumer better. uh, actually the money is not there. That's actually, yeah, not saying the money is not there, but I mean, it's not there in the sense of like that's already a very saturated space. Of course, if you look at a more boring thing, is like, solving problems for businesses, business to business is actually a more interesting space where less competition is, and in essence, really solving problems for businesses. That is actually where also technology comes in for yeah, I guess the companies to use technology as an enabler for growth, for growing the business and solving problems. Now, growth itself is not the goal, so profitability is in the end. So if you say, okay, I have growth and I have no end game, I don't have a plan, then profitability is actually what you should strive for in the end. So like I said, this Facebook example, there are a lot of companies from that era that actually started with, a lot of them also died the way of the dodo, so to speak. So Facebook is an example, the one who made it, so to speak. But I mean, profitability is actually where you, especially nowadays, really need to think of very quickly. Grow while being profitable. So rather than let's burn money for 2 3 years and see where it ends. There are companies that still do that, of course, and there's maybe AI has still that tolerance, because there's a lot of investment in that, and the business model is not mature yet. But that's actually where profitability is. Now, then we come to the $1 million question here. So, what is hockey stick growth? Hockey stick, you see already, a hockey stick has a curve at the end. So, hockey stick at the end is where the growth is like this. Yeah, you actually have the end, the stick, the end of the stick basically is the curve that needs to really spike up, and um, that is where you basically need to look at same resources that you invested, and then actually having additional growth or exponential growth, basically. So that is normally something that technology companies are better suited to than non-tech companies. So if you look at technology companies, because technology does the work for you, yeah, like adding more people, adding more salespeople, that might actually also stimulate growth. But in essence, technology is actually where most of these hockey stick growth companies come from. Um, and then, yeah, of course, I hear people, most people who will see my video actually will look at whether non-tech companies are investable. Then, of course, they are investable. If you look at currently tech under the current geopolitical stress that we are under, basically due to this gentleman in America who is upsetting a lot of trade balances in the world. Um, yeah, that also has an impact on what investors are actually looking at. And tech companies have been under a lot of stress at this moment. It will, of course, rebound at some point. But I mean, tech companies have this thing where they can have the same resources, they can grow exponentially. And if you say non-tech companies, it's more of a stable investment where you say, look, if it's non-tech or very limited tech, what is a tech company in the end? They always said at some point, you have an app, then you're already a tech company, but in the end, you're a very light tech company, basically. So in the end, does the app actually make things easier in your company? Then you are actually using that as a technology to enable processes that make your processes easier, basically. So but non-tech actually can be a very interesting angle. So at this moment, especially in this economic climate, of course, non-tech companies also become very interesting. If you look at companies that are investable, but it's usually more a conventional business. Then they don't have this hockey stick growth because it's more a gradual growth curve, but very predictable and very stable. So if you look at Main Street businesses, if you look at buying a dry cleaners or a plumbing service or like a bakery or something like that, or a supermarket, these things actually are they're not scalable unless you open more stores, meaning again more people, more resources. But still, it could be a very good investment if you actually are willing to accept that it doesn't have this hockey stick growth and it has just very predictable, stable returns. So just saying there's a different type of investor. If you look at venture capital actually says it already. Those are people who are In Dutch, I'm Dutch, so we have it called durfkapitaal in Dutch, which is called risk capital. So you are risking something, daring capital. So meaning, it can go wrong, it can go right, but you are willing to roll the dice and take the risk. So um, a Main Street business is actually not a very risky investment. So in the end, it's more a stable investment. And I'm just thinking like there are, of course, how you say this, startups that actually are non-tech. If you look at consumer goods startups, for example, could be there. FMCG startups, I've been involved in one. So in the end, it's less on a tech level, but yeah, in the end, it's more like everything or nothing type of companies where you are able to, yeah, with tech definitely you are able to say this is actually going to solve the problem. This is going to click with regards to consumers or with businesses. Yeah, that's an all or nothing thing because you can be overtaken by the next tech company. This is more of a fast development in that space, and someone who had a very good idea last year might be overtaken by the next good idea this year. And that is less the case again for non-tech companies because there is no tech then to, or very little tech to actually disrupt the space there. So uh, again, it's very investable. It's just a different profile. Like I said, venture capital funds are more about the risk. If you talk about, let's say, banks have the lowest risk model. That's partly because of legislation, but um, it's not maybe also not an equity investment, of course. But I mean, the bank is actually someone who can actually lend you money to finance your business. It's the cheapest capital around still. And you have a number of investors who are really specializing in less risky investments. So the risk profile is actually smaller than the venture capital fund. So you have gradations in everything. So in the end, it's just a matter of finding the right person to invest in your company. That's something that I think I will leave you with. Like I said, there's a large number of companies that yeah, need different types of investors also to grow. If you need help, please feel free to reach out to Alex at goldendragoncapital.co. So I'm an advisor for investments. I connect investors to startups and vice versa. I do this mainly in Asia, but I have customers in Europe and US as well. I do both startups and established companies, so also the private equity part of things, mergers and acquisitions, and advisory work for that. We have basically this channel, of course, is purely educational, but if you would like to know more, don't worry about the meter running. Just send me an email at alex@goldendragoncapital.co. Please don't forget to like and subscribe, follow us on Facebook, Instagram, and also visit our LinkedIn page. Thank you so much for watching, and I look forward to making the next video and hoping, of course, you want to watch that as well. Thank you so much. Bye bye.